Welcome to Recogs, the show where we learn how the world's best business operators build consumer brands from sourcing to selling, brought to you by Manufactured. Manufactured is an online platform that helps brands manufacture, finance, and distribute inventory across 20 industries or 25 countries. If you're interested in learning more, for example, if you're a brand owner and you're looking for PO financing or inventory financing, or you want to explore our manufacturing options, check out manufactured.com. Thank you, Becca Milstein, for the intro to our guest today, Bryan Wolff. Bryan is the president of All Voices. All Voices is an employee relations platform that makes it easy to manage employee relations issues. But in this conversation, we're not going to talk about All Voices. We're going to spend our time in this episode talking about his time as the CFO of Bonobos, the men's clothing brand. Bryan was the CFO of Bonobos before they were acquired by Walmart, and we're also going to be talking about his time as the CFO of Thrive Market. We explore the role and the challenges of being a CFO at a fast-paced growing brand like Bonobos, how they dealt with inventory planning, excess inventory, raising capital, building out new SKUs, D2C, and managing D2C and wholesale in Nordstrom, and as well as the role of the CFO at a retailer like Thrive Market. So kind of contrasting being a CFO of a high-growth brand versus a CFO at a retailer. This is a really interesting conversation. Really enjoyed this. Thanks again, Bryan, for coming on. Without further ado, here's Bryan. Bryan, thank you so much for joining me here today. How are you?
I'm great. Thanks, Mike. Thanks for having me.
Oh, really appreciate you coming on. So I think what's obviously you've had an incredible career and really interesting background since you've been a CFO at a high growth brand in Bonobos, and also a CFO in a retailer with Thrive Market. Can you talk a bit about what the role is of a CFO at a high growth brand, and as well as what the role is of a CFO at a retailer?
Sure. And I'll sort of orient the question towards, I think a strategic CFO is really someone who will do the basics, right? You can sort of look up online, what does a CFO do? And we'll say that person can do all those things. And then, and I think the most important thing is, one, don't run out of cash. And so what that practically means is understanding what the company's next milestone is. Whether it's the next financing round, whether it's a sale or acquisition, whether it's cash flow break even and profitability, self-sustainability, et cetera, and ensure that the company has a path to get there, right? And that path can be pressure tested under a bunch of different scenarios, in that you make conservative assumptions to ensure that the company, even if a few bad things happen, still is able to get to that next milestone. Oftentimes that next milestone for a growth company is a financing event. So that means understanding capital markets, understanding what metrics are necessary, how big the company needs to get, what your growth rate needs to be, what underlying metrics need to look like, and then ensuring that you've been cultivating those right partners as financial partners along the way, so that you can be successful at that next milestone. So that's sort of one component. Another component is helping to shape the numbers that you need. And that means being a good allocator of capital, and understanding the unit economics of the business at, the product, bundle, customer, order, category, subcategory level, store. And then also partnering with different business leaders throughout the organization to make sure they themselves become good capital allocators. And that is really crucial, because in any sort of retailer or growth company, capital is finite, as sort of people have learned a hard lesson over the last couple of years, and ensuring you get the best productivity and the best return on that capital is really everyone's job at the company. But I think a good CFO will set the tone and will help leaders and partner with them to enable their teams to execute against that.
So I'm glad the first thing you brought up was don't run out of cash, which of course is the job of any, especially obviously emerging company. I mean, any company, but emerging company, you're probably thinking about that a lot more on the day-to-day side than maybe an established company. But how then do you think about cash in the perspective of a apparel brand, for example, or any inventory based any inventory based business like a Bonobos, for example, where you obviously have, inventory. When does it make sense, for example, to use that cash to actually purchase that inventory versus debt? How are you kind of thinking about these things? It seems like cash is very tricky in terms of what to actually do with it from a brand perspective.
Yeah, no, it's a great question. And part of the issue is accounting. So, I sort of joke that, GAAP, or generally accepted accounting principles, it's like a Swiss Army knife in that it can do everything, can cover every industry, but it does nothing really well. So if you're in a pinch and you need to screw something in, having a Swiss Army knife is great because it could, screw one screw in. But if you're going to screw in 100 screws, you probably don't want to use the Swiss Army knife. You probably want a tool that's actually meant for that. And that's sort of the problem with retail companies is that cash goes out the door when you buy something, but doesn't get expensed in your income statement until you sell it. And so if you're used to, or you think about running the business off of an income statement because you're a financial analyst or you have, basic financial training, you can be severely misled because what is happening on your income statement is divergent from what's happening from your cash flow statement or just in general from the cash in the business. And so understanding how those two interact and how cash gets depleted and accumulates through different periods of a company's year or other periods, and how that gets represented along your financial statements and how you're able to communicate that to the company, to the board, to the broader investing community can be a real challenge. And it can also lead to a lot of mistakes. It can lead to bad cash forecasting. For example, you have to make a buy that you didn't realize you have to make. That buy that you're going to make, accumulating inventory, will not hit your income statement. And if you're just looking at your income statement, you'll totally miss that. It also means that you can misalign and be poorly understand where value is being created or really where it's being destroyed. So if a certain business unit or region or product line or category consumes more cash or consumes more capital or uses more capital, it may actually be destroying value, even though it may look profitable or it may look like it has a high margin or some other metrics that are important, but are not actually correlated with value creation.
I'd love to kind of like dive into that in terms of how you think about, value creation, and also I guess how you would analyze a company. Obviously, as you said, it's not just the income statement. You have to also look at, obviously, the cash flow statement and also the balance sheet and see what maybe like the COGS level are at. And do you think at all, for example, on the COGS side of things, that a company might be, might appear to be a lot more valuable, for example, when they have with maybe sales and high margins, whatever, but maybe they're actually holding like a ton of inventory that actually might not be able to actually convert into cash.
When I was at Bonobos, we're a retailer, and this is actually a relevant time of the year, right? Holiday. And I remember Cyber Monday, and this was, 8, 10 years ago, when Cyber Monday was probably a little bit bigger a deal than it is now, but still Black Friday, Cyber Monday are pretty important. I think it was like 3.5% of our sales for the entire year was on one day, right? And, obviously, do math, and like one day should be 0.3% of sales, so it's 10x an average day. And I used to joke like, hey, look at the run rate profitability of our company on this one day, right? Which was obviously sort of a silly note, but it's not that different from how you can represent financials over some short time period, right? So if you don't properly account for, to your point, inventory that goes unsold, that is expiring, that is worthless, you can look a lot more profitable than you actually are during any given period of time. There's lots and lots of of tricks, I guess, or call it. There are nicer words to call it that you can use to present your financial position to be more attractive than it is.
Yeah, well, I guess then for like retail businesses, especially in like the boom when retail businesses, inventory based businesses were were at kind of the height as being, appealing to venture capital from that, which that has kind of soured a bit over the last few years. Not to say that there aren't many investors that still invest in inventory-based businesses, but then would then on the fundraising side, could then the early part of next year look a lot more favorable just because the last 3 months, where you did really well, but it happened to just be that retail is a cyclical business.
I mean, Bonobos, we raised money in December for like 6 or 7 years in a row. I'm not even kidding. Like it was literally like 7 years in a row, like clockwork. We'd raise money in December because that's when our sales were strongest. And there's just we're raising from people, who didn't really understand the seasonality of the business, nor did we fully understand the seasonality of business. I mean, we did later on, as the data set matured, and we would look and be like, oh my God, this is amazing. Look at this uptake, and we'd be able to, raise money off that. And again, to your point, it was a different time. But even oh God, even 10 years ago, 8, 10 years ago, there were savvy investors saying like, hey, DDC is not for me, and sort of had people who had invested early in the space with companies that were, and we could all list them, highly valued and then flamed out and never, created enduring value, so realize the pitfalls and the challenges that come with, with building, creating, and running a direct to consumer brand.
Let's back up for a second too. What attracted you to the opportunity to begin with at Bonobos, and how did you end up meeting Andy Dunn?
Yeah, so Bonobos is really personal to me. Andy and I went to business school together. And so he's a close friend. We were, he was at my wedding, I was in his wedding, that type of thing. And Andy and Brian Spaley, the other guy who founded Bonobos, are still two really close friends of mine. And so I was the first customer of Bonobos. Literally bought the first pair of pants that was sold. I think I was the third investor in the company. And so I was just around at its inception. I remember, it was a PowerPoint before it was anything else, like most businesses. And I sort of witnessed its birth. Um, and as a result, it was very personal. And Andy, I went and worked for a hedge fund and was sort of in New York doing a finance job. And Andy was running this business. And during the day, I'd like put on a suit and go and work my finance job. And then at night, I'd come home and build the model. And on weekends, Andy and I would meet to talk marketing strategies or like figure out team dynamics and product line extensions. And so that was really fun, and that was really fun for me. And so at some point, Bonobos raised institutional capital and was looking to expand more more quickly and needed a financial leader. And I interviewed for the job and got it.
How did you think about product extensions from your side? Because of course, I imagine from the CFO lenses too, it's making the company as well a bit more complex from an inventory perspective as well. Maybe you'll actually have maybe excess inventory of products that maybe aren't selling per se. So how did you think about testing new products, for example, and deciding on which new categories to kind of expand to, maybe even go deeper in pants or even obviously expanding outside of pants?
Yeah, no, it's a great question, and one which we wrestled with a lot at the time, right? Because we were, for the first 4 years of the company, I think just a pants company, then just the bottoms. We did some shorts and swimsuits. Um, and pants typically I think is like 25 to 30% of apparel sales for a guy. And we were so overweighted in pants that we just said, hey, wow, if we are able to get our fair share even of other categories, we can double, triple the business. And so that was sort of the opportunity, and why sort of it made sense. And then the question is like, hey, could we deliver a product that was consistent with our brand and what customers wanted and why they were hiring us, what job we were doing for them. And we made a we made a lot of mistakes over the years, but eventually, we got a lot of it right and ended up, building meaningful shirts business and outerwear, um, and collar shirts and even suits and formal wear. But it took a really long time, and we were not. Um, One of the other challenges, and you sort of mentioned inventory as a way to mask the true profitability of a business. Another one is looking at your fixed cost allocation, right? So, you have a design team, you have a merchandising team, a merchandise planning team, and you know there are some components of fixed costs associated with those teams, right? If you have a few more category, a few more SKUs, you're not going to add another merchant, but at some point, you will, right? And getting that cost accounting, or really just understanding the actual true cost of product expansion and growth is something that is pretty hard, and a lot of companies don't do very well. Um, and it's something that it took us a while to get right. The bigger apparel companies, the sophisticated ones that own a lot of brands, they're pros at it, right? Because for them, like that is core to the business, and they are focused on profitability. And so, designers costs actually go into COGS sometimes, and it's a very different way of looking at the business. But when you're your growth company and you're a startup, you sort of have your fixed costs, and you don't think about how they get allocated towards different growth initiatives.
No, it's a really good point, because I think that when a brand might think about expanding to new lines, you just think about the inventory cost, for example, or okay, what are we going to do on the marketing spend? These are all kind of like variable based off, of course, of how much you order on the inventory side versus of course how much you spend as well on the marketing side. But also, like, okay, if you are going to invest in going into a new category or different category, what is that actually from like a human resource element as well, on the fixed cost salary side too, which is also obviously like a big cost as well. So it's not just variables, and so it needs to be like,
And the incentives are there, right? Because remember, one of the things with e-commerce is the fixed cost component is like the package you're sending, right? So you got to pay for shipping, you got to pay for the box, and there's somewhat variable cost to pick, pack, and ship. But like in general, more items in the box and or higher value, dollar value in that box that goes out makes for a much more profitable order, right? So if you're going to put a pair of pants or two pairs of pants in the box, if you put three shirts in that box as well, the contribution profit on those shirts is much higher than if someone just ordered three shirts.
when we think about bonobos, I know obviously Andy coined the term DNVB, and they're one of the kind of first emerging DNVB D2C brands that we've had, especially in the social era. Um, what was your first impression overall of the D2C channel, and kind of has that changed to where we are now?
Yes. Yes. I think like a lot of the venture capitalists or the investors early on, I'm talking like 2007, 2008, I was way more positive on the prospects of D2C, um, you know, becoming a very quick way to grow and to build a big business. The benefits are sort of, hey, you don't have any stores, right? So you get to take out a meaningful fixed cost. Um, One, two, you can consolidate your inventory, right? So you don't have to have inventory in stores that necessarily needs to sell, but you can have one pot of inventory. So you should be able to increase your inventory turns. And then three, you're not constrained by geography, right? You can sell anywhere in the country or really anywhere in the world, versus just, hey, within a certain radius of the store, the physical storefront that you've created. And that, like those three elements were incredibly promising. And then the last point I'll say is, you were able to have a direct conversation with your consumer. Right now, brands had, starting with the Gap and Mixie Drexler in the 70s, had sort of started opening stores themselves, and the department stores were sort of already on the decline at that point. But the fact that you were able to sell directly to a consumer, you had that relationship, right? There was no middleman. You knew exactly who you were who you were selling to, who you were able to target and retarget. And so all that, was incredibly, incredibly promising, right? And in 2007, 2008, that time period, there were fewer companies doing it. And I would have said back then that the prospect of, there being big brands created during this time period and superseding legacy brands was pretty great. Um, but as you sort of mentioned, and I think what the world has sort of realized now is that there are a lot of challenges to to DTC, to direct to consumer. And I would start, and so I guess I would say, simply like, no, I don't, I think they're in general not good businesses or really challenging businesses. You can still create a lot of value for sure, and there are still success stories, and there still will be success stories. But it is structurally it is very difficult and very challenging, and you're sort of swimming upstream, so to speak. And the biggest challenges, um, I would say, is one with respect to customer acquisition, like all the value went to the consumer aggregator companies, right? Like Meta is worth $1 trillion or almost $1 trillion for a reason, right? Google's worth, I don't know, almost 2 trillion, 1.7 or something. Amazon 1.5, even TikTok, only $300 billion. Like that is where all the value went, right? Like the people who are able to capture and or create demand. And that was something that just wasn't the case, 15 years ago when we started. Bonobos was one of the first companies to advertise on Facebook. We had a relationship because, we went to grad school at Stanford where, where Facebook was being built at the time. So we had, some of our classmates went and worked at Facebook, were early employees. And when they started to monetize, we said, hey, we'd like to advertise. And we're able to sort of cut the line. And at first we were like, oh my God, this is amazing. Um, and, very quickly, even then, any sort of arbitrage opportunity got like whittled away. And, even in the early days, Facebook was very good at capturing the value that they created with respect to advertising. Um, and so that's sort of one problem. Other problems, there's no barrier to entry, right? Again, as sort of Mickey Drexler famously said, anyone with a sewing machine can be a clothing brand, right? You don't need to have capital to open stores or even, really to make stuff. That can sort of be outsourced as well. Um, Inventory is expensive and holding inventory, and lots of companies have been thoughtful about, how to finance that and how to structure inventory. Zara's been like the best at it by far, and that's why they are one of the real valuable apparel companies. And then just day-to-day management of marketing initiatives is really expensive. It's not easy to manage your customer lists and to um, you know deal with the day-to-day sales, and like there's a lot of expense to this. And then lastly, the real challenge, I think, which was not known at the time, was there really are no economies of scale, or few. Typical business, as you get bigger, marginal costs go down, and or you have fixed costs that you can amortize over a longer base. For D2C brands, which were small, we had a few we were packing ourselves and putting stuff in boxes, answering the phone, and then all of a sudden, like, okay, we got too big. We needed like a warehouse, right? And that was a cost. And Amazon has spent, God knows, tens of billions of dollars over the years, and is spending tens of billions of dollars every year to build out that infrastructure, right? And if you're a brand, like, now there's everything is as a service, and you can, pay a marginal fee. But back then, as you grew, you had to invest more money. So it ended up being a pretty poor venture investment because, good venture investments are ones where, they don't require capital to grow. And D2C companies continue to require, massive amounts of capital to grow.
That's a number of great points. I think also kind of like the promise of D2C, and that, hey, we're also going to save like customers money, just because we're then taking out the middleman with like the retailer, and like of course we can be maybe more dialed in on the inventory side, since we're not spreading out inventory in like a wholesale model to like several stores, right? It's like we can kind of have more like centralized inventory shipped directly to you. So it'll be like less kind of complicated, complex from that from that standpoint. And but that of course hasn't really been proven out, because of course like all that kind of money that would be like saving the customer, it went directly to marketing, directly to Facebook, directly to Google and what have you, and those of course became like the behemoths on the back of that as well. So totally understand. I mean, I'm also kind of curious too, like, I had Andy on my other podcast a couple of years ago, and I thought something that he said that was really interesting was his, how I think he said that if you like, he's kind of advising brands or talking to brands about how really think about wholesale, really think about like direct to consumer is great, but also think about wholesale channel. In your seat, as someone on the CFO side, and you understand what the margin profile is for D2C and understand what the margin profile is for wholesale, it's considerably lower. How do you think like looking back? I know that Bonobos that was Bonobos is known as from the D2C side, but how do you think about wholesale for retail brands?
But in general, selling more product and getting more product in the hands of your customer, so long as it's done in a way that protects the brand's integrity and delivers a good customer experience, is a good thing, right? And yeah, wholesale is, and we, at Bonobos we did wholesale. We sold to Nordstrom, um, and you know, on the like truly marginal basis, we made less money on it. But the actual, amount of work that had to be done for us was lower. In terms of getting bigger volumes, we were also able to just make bigger buys, right? So instead of buying, you know, 300 units of an item, we could buy 800. And that, reduces your actual cost when you're negotiating with your vendors because, there is some economies of scale for them in terms of being able to like, you know, make changes and like once you're doing a cut, you're doing a cut. So it was useful and it was valuable to us. The problem is it doesn't always work, and if it doesn't work, then it can be really time consuming. You can have like inventory putback issues where it creates cash crunches depending upon the deal you have. Which just gets back to my original point is like if you have a good partner, if there's a good wholesaler where your customer is in there shopping, and if the presentation of your product is reasonable in a way that again provides a good customer experience, like I'm all do it. Is sort of my advice. It was true then, but it's certainly true now. Customers will be able to find you, right? If they're like, I walked into a store and found a brand, that's an amazing brand. Where else can I buy it? What else do they sell? Like, that's a no-brainer, right? And you can be more thoughtful if there are real, if there's a big overlap between where your customer shops. You can provide only certain SKUs, or only certain styles to the wholesaler in a way that may protect your most profitable products. So you can be smart about it, but I am very much in favor of it. But the key is, if you do it, you have to do it well, right? Because like anything, you want to exceed expectations, right? So making sure you have reasonable buys, reasonable projections. You understand what is important to your retail partner, which is usually margin and turns, right? So if you can improve the margin and turns of your buyer, they're gonna like you. So like make sure that you're set up with respect to what you offer and the size of your buy and or marketing support and or other support you may provide to make the retailer successful, right? A lot of mistakes get made because the D2C company thinks only about D2C. It's like, oh, wholesale, okay, we'll just get it out the door, right? When they don't view it as a partnership and they don't think about making the merchant at the retailer successful.
Yeah, and also, making sure that they kind of pay attention to their own metrics and also like their own category set and making sure that like their turns are, let's say, top 50 percentile or what have you, to make sure that retailer actually wants you back, right? And so concentrating, and also, not picking, but targeting maybe like the right retailer too, that also maybe matches your brand in terms of, is it premium, is it more so mass, what is the kind of the right one that you want your brand to represent. And I think that like what I appreciate that you said is also like building your brand through wholesale and retail. And I think that is sometimes a little bit counterintuitive, because I think when you think about building your brand, oh, D2C, that's like the ultimate brand because you own like that entire customer experience, right? But at the same time, wholesale, that is where, many more shoppers will shop, and actually, like, the first sense of discovery will be probably then, unless you really load up on the marketing dollars for your D2C side. But I do think I do think that wholesale is an incredible way to build your brand, that sometimes it is like a bit counterintuitive.
It also could be really profitable. Like it doesn't need to, you can make money on wholesale, right? It's like it's a different margin structure, but it obviously costs a lot less to pick, pack, and ship because you're sending big bundles via truck than versus one item via plane typically. Um, and there are economies of scale to selling large amounts of the same item to one retailer.
I know, obviously, when we started this conversation, you talked about how, the first job is obviously protect the cash, always have cash, don't run out of cash. Um, when when you are a, you know, growth venture back growth venture back company, high growth company, when does it make sense to actually use debt, for example, on the inventory side, or to use cash in order to actually fund and actually buy the inventory?
Yeah, so we raised a lot of debt. At Bonobos, and I have sort of a different point of view on this than others. I think traditionally people are like, "Oh, fund debt with inventory," right? Okay, fine, and that sort of makes sense if you're a like break even slash profitable business that has fluctuating inventory levels because of seasonality or whatnot, or just not even seasonality because it is more um, dollar efficient to buy in bulk, right? So if you're making 4 buys a year, your seasonal business, you may not even be seasonal, but you're going to buy 4 times, so your inventory is going to go up and then wind down. Then it obviously makes sense. Obviously, then it makes sense, I think, to have use debt, right? And you have a revolver that gets drawn and then gets paid down through the time period, right? That's sort of traditional use of debt by retailers to fund inventory. If you're a growth company like we were, you're a venture backed company, you're not making money, right? And so, money is going to buying inventory. It's also going to, paying salaries. It's also going to, Google and Facebook and marketing. And like those are sort of the three main sources. Where it comes from is sort of irrelevant, right? And if you're raising venture debt and you're going to be a growth company, really all you're trying to do is arbitrage your share price today versus your share price in the future, right? Maybe you can have some more capital today, but venture debt, like the way it's designed, is not permanent, right? The duration on these things is like, a couple of years tops, right? And, it usually starts amortizing within a year or so. And so it's not permanent capital. And, maybe you're at that inflection point of a company's life cycle where, you are almost cash flow generative and, 2 more years will tip you from burning cash to generating cash. And then you can, leverage those cash flows to, to not just service your debt, but to, pay down your debt. That's like one option. But typically, you're raising a round now and you're thinking about, okay, how do I get to the next round? Right. And you may have debt to increase the resources available, knowing that you have to replace that debt. And typically you're going to replace it with equity. I mean, or potentially more debt, but at some point you're going to have to replace it with equity because the debt is not permanent. So really, if you're raising venture debt, all you're thinking about is, okay, dollars I need to get today. How many shares would that be if I had to sell equity versus dollars that are going to be needed to pay back that debt in time, right? Because the debt amortizes or the debt has interests. And then what's the share value in the future? And if that is there's often an arbitrage because hey, we think we're going to be worth twice as much in 18 months, right? Because we're going to double the business or triple the business will be twice as much. So we'll raise debt knowing that we'll raise $5 million, we'll have to pay back 6.5 million, but our share price will be twice as high, and so we'll be paying it back with fewer shares. That's sort of the arbitrage opportunity. The challenge for retail, and if you're a venture backed company, is at some point you're going to have multiple compression, right? Because at some point you're going to be valued off of EBITDA and off of earnings power because you're a retailer, and that transition is really really painful. and could sometimes take years, to satisfy or to navigate.
From the fundraising perspective, and I guess how you thought of it, because it seemed like a lot of like the DC companies back then, I mean, and now too from investors, but a lot of it's kind of focused on like top line, kind of like top line revenue, not as EBITDA centric. Were you all focused on EBITDA during like your time at Bonobos, or was the company still like so young that it wasn't yet really like a thought, and you were obviously raising at such a clip?
We weren't. So we were thinking about contribution profit. And so, we were very, very focused on, and you have to be in a retail, retail environment. If you don't, you're dead, right? Because we were focused on our initial markup, which was, effectively if we sold things at full price, um, what our profit would be just on the sale, and then on all the different additional costs that would go along with the sale, from merchant acquiring fees to pick, pack, and ship to postage to customer service, et cetera, to get to a contribution profit. And so we were very, very focused not just on revenue growth, revenue is important, but also on the corresponding margin and profit associated with those revenue dollars. The challenge, we weren't thinking about EBITDA completely because there was some fixed cost that we had to get over to get to EBITDA or break even profitability, right? And so we had our revenue, the variable or quasi variable costs associated with that. We'll get to our contribution profit and thinking about when that would overcome our fixed costs, right? Our fixed costs being, obviously the people that went into making the clothes, and then the people who sort of ran our marketing marketing department as well as those marketing dollars.
Yeah, I mean, also, I think too, like the website. I've heard Andy talk about how at one point it had to be split between San Francisco and kind of in New York and everything like that, because this is kind of like before the day where we didn't really know what the winner was. Shopify, big commerce, and everything like that. So companies were kind of doing themselves, but Bonobos was one of those brands that was doing themselves. So of course you're paying also like engineers. Engineers aren't cheap, and so you have these also like incredible, as you say. I mean, obviously like fixed costs that you're doing, like these really big salaries that you actually do you actually also have on the payroll, which of course looks very, very different from like starting like a D2C brand today.
Yeah, we didn't talk about technology, and I mean that we destroyed a lot of value and burned a lot of cash because of that very fact you just said. We took money from venture capitalists early on, and made meaningful technology investments, mostly because Andy, to his credit, was like really prescient in his like thoughts, right? He, started building this in 2007, and back then the tools were very, very rudimentary. And basically, he was like, "This is crazy. Someone is going to make these tools really easy." He was like he sort of foresaw Shopify, I guess, and Shopify was founded at the time, but it was a tiny company. Um, and so, we made investments thinking, "Hey, maybe we could be Shopify." And um, we had the main brand and we had this technology that powered the brand. And, for a while, our intention was, okay, well, can we actually have Bonobos be the first customer of this technology and then sell the technology to other people? Like Amazon famously has done this incredibly well, right? Like that's how AWS started. That's how marketplaces started. We were not at the scale of Amazon. And you have to be at massive, massive scale, to make that work, to have your first best customer. And so, for us, it was, having a building and
I
growing.
didn't realize that. So Bonobos was also working on trying to do like similar to like AWS or like Shopify, of like if obviously
We
being
spun that
like that
company
kind of
out.
platform.
So that company spun out.
Oh wow.
Yeah,
Oh wow. Okay.
yeah.
Shoot, I didn't know
Oh
that.
yeah. We had at one point
I
like
thought it was
20
wow.
engineers or
That's
something.
crazy. Wow.
It was wild, and it created massive, massive cultural problems because we had like the clothing team in New York and the tech team in San Francisco, and they almost spoke different languages, right? Um, and it was so hard. It's so hard enough building a clothing brand and like a D2C brand like that is, capitally intensive, that is challenging, that involves, so many talented individuals, so much hard work, and so much luck, that to saddle that with like building a technology company, um, was almost killed the company. And yeah, it was a very, very challenging time. It also, ironically, the company wasn't even, because the technology company was focused on building their own technology, they weren't even servicing Bonobo. Bonobos wasn't even a good first customer. And so but it was like, hey, there'd be one thing if it's like, hey, we have this expensive technology team, but oh man, we have the best tech. Our technology was terrible. And so it was like, it created a horrible, horrible dynamic. Um, but yeah, I mean, today you can do, everything as a service and do things much more cheaply.
Yeah, no, totally. On like the fixed cost perspective. Wow, that's wild. I didn't realize that actually spun out into like its own a technology company. I thought I thought the purpose was, hey, like shop. We don't really know what like the winner is here yet on the tech stack side. So like we're gonna just build it ourselves and use it for us. I
Listen,
didn't
this
realize that.
this is
Yeah.
why, and I tell founders all the time, like picking the right capital partner who you take money from is really, really important, right? We took money from venture capitalists, and a few of them had like in the same fund we were in, were like Facebook, and like so they're sitting on like career making funds, and they're like, yeah, sure, go for it. Like to deliver a 3x or a 5x or something. If you're a clothing company, that's like a home run, right? And for them, I was like, that's a rounding error. So like like swing the fences was sort of the approach, which wasn't the right thing for the business, right? Just we were a clothing company. That's just where the assets and value of the company was derived, and where the value is being created. And so, like that really almost killed us.
I want to talk a little bit as well about Thrive Market too. When you're CFO there, obviously, being like, talk to me a little bit about the difference between being a CFO at a brand. I know we talked about how obviously like managing inventory. I think we talked quite extensively on that side, and as well as how you thought about like different sales periods and what have you. But how also what are you paying attention to as a CFO as Thrive, and kind of what you're focused on? Because of course, like retailing, like low margin business, but high volume in terms of the amount of products that you're selling. How did you think about it from Thrive Market, and how was that different to Bonobos?
Yeah, I mean, it's a great question, and Thrive was very, very different. And listen, retail at the end of the day is sort of simple business. Like buy for a nickel, sell for a dime, right? It's like that's sort of the business. Um, but the manner by which that gets implemented, and what it means from a strategic perspective, and what it means from a like how you manage the business, what metrics you follow, where your resources and capital are deployed, are vastly different. So at Thrive, to give you an example, at Bonobos, our average order value was a couple $100s, but our average unit price was around $70. So we would sell a product, and the average value of that was $70, and the initial markup in terms of the cost that it took to create that product was around usually around like 30%, call it 25%. So 25 was the COGS, 75% margin on that $70 item. At Thrive, our typical average unit cost was $6, and the margin was 30%, 70% cost, 30% margin. And so what you need to do to make a profitable order on one versus the other is very different, right? So, at Bonobos, we wanted to maintain integrity, not discount, of our products, and sell them as close to full price as we could. And we really only needed to sell two, at a time in a box. And customers, our typical customer purchased, 2 times a year, right? So it was making sure, on those two purchase occasions, weather changes, guy realizes he needs new clothes, we were able to find him, and we were selling him something that was sort of at full price. At Thrive, customers bought every month, right? You're buying like literally groceries that you consume. And for us, making sure customers bought 10 items at a time was the difference between a profitable order and an unprofitable order, right? Because you can only put so many items in a box, right? And each item only make, you only make few dollars on each item, and it costs you money for the box, for the postage, for the person putting it in the box. So for us, but the person's going to buy over and over and over again, right? And so, yes, we needed a box to be of a certain size, right, for a person to be making a profitable order. But the key for us was, how do we get people to shop enough around the catalog or the store or the inventory areas so that they can create boxes, right? Because we put in constraints. We said, like, you can't just order one thing, right? We're not just going to send you, one, $6, jar of, or $10 jar of almond butter. That's going to cost us $12 to ship to you and $7 or $6 to buy. Like, we're not going to do that. So how do we get someone to a $50 box? And that was, hard, right? And for us, it was like, okay, how do we get them to explore new categories so that this person can have 20 or 25 items that they're routinely buying, knowing that, every month, 7 to 10 to 12 of them, we're going to go out of stock and they're going to need to replenish. And so that's on the basket size. But on the inventory side, right, for Thrive, what it meant was we had limited inventory and we had to run the distribution centers, right? Because we had a low margin business. So, one, we couldn't take charge-offs, right? Charge-offs would kill us because, our starting margin, was so low. And two, the pick, pack, and ship was a meaningful cost of the overall cost of the business. So even though we had to have, our own warehouses that we didn't own the buildings, but we leased them, our own employees, we had to design the picking and the packing in a way that fit our orders and reduce the overall cost, right? Because we couldn't outsource that. It was paramount to, making money on a box. We had to get the consumer to buy the right amount, but then be able to put that stuff in a box in a cost-effective way, right? And so that meant, we had a limited amount of SKUs. We're only going to have one kind of everything, really. And you were going to trust us that we would pick the right kind. Maybe we'd have two of certain high volume stuff. And that we would be thoughtful about where the stuff was in the warehouse so that we minimize the cost to put 12 items in a box, because that was our typical order. At Bonobos, we outsourced all that, right? Could we have done it a little bit cheaper? Maybe, but, if you're selling two $70 items at a 75% markup and making, $120 of profit in the box, you can overpay a little bit to have someone pick, pack, and ship it. And you don't have to optimize, right? We can share a warehouse with someone else and they can design the means by which, products get pulled and put into a box. And, we can pay a little more for that. We just didn't care. It didn't matter.
What would you value more? $100 of inventory. Let's say it's inventory that you can sell. That is like a hot product. Like, let's say Bonobos pants, or $100 cash.
I mean, if it's $100 of product that you can sell, you obviously want the product, right? Because that $100 of product, assuming you can sell it at a profitable contribution margin, is going to turn into, $400 of sales less some costs, and you'll keep more than $100. But the caveats you gave are massively important.
Exactly, that it's a product that actually can sell. Absolutely.
Because remember, the other accounting challenge, and we didn't really talk about this, is things sit on your books at the price you paid for it, right? And you're not like, if we were to mark our inventory to market every day, it would be sort of hilarious, right? Because you'd have, we bought these purple shirts. Oh my God, we picked the right color purples. These sweaters, Henleys are in, or whatever, great material. The value would go up meaningfully, right? Because we know we're going to sell them, and we know we're going to sell them at full price. And we're going to make, we spent $100 to buy this shirt. We're going to make $400 on each shirt. Whereas, if it's December, what's the date? The 6th, and then all of a sudden, the shirts are $100. In January 6th, they're probably worth $20, right? There's no way we can get anywhere near that price for them. But on the balance sheet, it looks exactly the same.
Right. That's a really, really great point. That's a really great point, because obviously it's just like on the balance sheet, it's just like the total cost of like COGS or whatever you paid for it. That obviously doesn't fluctuate. Bryan, thanks so much for your time. This has been a lot of fun.
Mike, it was great. I really appreciate it. Anytime you want to talk, I'm happy to do it.
And there you have it. It was a pleasure chatting with Bryan. Bryan, thanks again so much for coming on this show. This episode and the show is brought to you by Manufactured. Once again, Manufactured is an online platform that helps brands manufacture, finance, and distribute inventory across 20 industries in 25 countries. So if you're a brand, you're looking for PO financing or inventory financing, or if you're looking to explore our manufacturing network, check out manufactured.com. I'd love to see if we can help you. Thanks for listening.